Well, good morning, everyone. It is a pleasure to be here this morning in this regional plenary on financial products and services for migrants that lead at Krea University as organized as part of CFI's Financial Inclusion Week 2021. My name is Fabrizio Valenti. I'm the head of the Financial Inclusion team at LEAD, and I will be moderating this session. I'm joined today by a remarkable panel of experts and practitioners. Rupal Kulkarni, CEO of Shram Sarati, that is a leading institution working on financial inclusion of migrant laborers in India. Hi, Rupal. Thank you for being here.
Hi, Fabrizio. Hi, everybody.
I'm also joined by Rahul Ranjan Sinha, Associate Director of Client Insights for Impact at the Grameen Foundation in India. Hi, Rahul. Great to see you.
Hi, Fabrizio. Hi, everyone. Great to be here.
And Varun Agarwal, founder and CEO of India Migration Now, immigration data research and advocacy organization. Good to have you here, Varun.
Thanks, Fabrizio. Good morning, everyone.
So in the next hour or so, we will be discussing advancements and issues in the design and the delivery of financial products to improve the financial health of migrants and their families. We will be focusing on India and on domestic migrants, but I'm sure that the insights and recommendations that will emerge through the discussion are applicable to other settings as well. So we have actually a pretty content-packed session. So without further ado, we'll begin our discussion starting from a brief overview of the result of a study that we at LEAD have conducted on financial decision-making in migrant households in early 2021. I will be sharing my screen for a very brief presentation. So I don't think that it is necessary in this forum to explain the social and economic significance of domestic migration in India, which alone contributes to an estimated annual monetary flow of $24 billion in remittances alone. So with this study, we took a deep dive in migrant households' finances and tried to understand how financial decisions unfolds in these units. First, we investigated who is the primary financial decision making in the household across multiple types of financial choices and how this is influenced by different factors, both at the individual and the household level. And then in this study, we flipped the analysis from the decision maker to the financial decision itself and studied how these are affected by migration and household characteristics. So before we dive into study results, I just want to spend a minute or so to highlight a few details about our sample, which has been recruited through an IVR blast in Bihar, Jharkhand, and Eastern UP, that is, in central India, and tallies up to approximately 1,200 respondents, both migrants and non-migrating family members from approximately 600 households. And please bear in mind when looking at these results that all migrants in our sample were male, so there is a bit of a bias in that regard. First of all, in terms of characteristics of our samples, in terms of duration, we follow census definitions and refer to migration up to 6 months as temporary or seasonal, and above 6 months as semi-permanent. And in our sample, 57% of the respondents identified themselves as temporary or seasonal migrants, while over a third as semi-permanent migrants. Interestingly, over 80% of our respondents use formal channels to submit their remittances, with bank-to-bank transfers being the most common. And while this appears to be in contrast with previous literature on this sector, which reports informal channels as being very popular among migrants and their households, we think that we could explain this discrepancy with the advancements that we've seen in financial inclusion in India over the last decade, as this literature actually is quite dated in that regard. And finally, in terms of income, the average household income in the sample is 10,764 rupees a month. That is approximately $145. Interestingly, in most cases, the primary source of income, household income, are the remittances themselves that are received from the migrant, which further stresses the importance of unpacking financial decision-making dynamics between the migrant and the origin household. Now, let me give you an overview of what we found in terms of how financial decisions are made in migrant households. Starting from the migrant at home scenario, when the migrant before the migrant has migrated or between migration cycles, we find that the migrant himself tends to be the primary decision maker for almost all decisions, which is not surprising when we see that remittances are such important parts of household income. Aside from the migrant, older men are found to be the other members of the household with decision-making power, indicating a very strong gender pattern. And overall, there is relatively little variation in how decision-making power is shared when the migrant is at home. But things change quite a bit when the migrant is at destination. First of all, we notice that the older man emerges as the primary decision maker for all decisions, strengthening our gender findings for these sort of decisions. But at the same time, we see that the migrants retain power on large financial purchases and non-emergency borrowing, which suggests that migrants maintain influence on important and low-frequency financial decisions. But at the same, we also find that spouses are identified as the primary decision maker for decisions on small daily purchases, and to a lesser extent, for decisions on education expenditures and household savings. Additionally, with regards to other household members being consulted in decision-making by the migrant, interestingly, we find that high-value, low-frequency decisions are the ones that households report as being the most consultative, such as large financial purchases and non-emergency borrowings. However, we find that male members of the household, i.e. the migrant or the older man, retain final control over these decisions in the event of a disagreement. Now, I like to flip the focus of our analysis from decision maker to the decision itself, and for the sake of this presentation, I will only focus on savings. In the paper, in the study itself, we go beyond that, but for this for this forum, I will just focus on savings. So in this context, we observe some interesting results. First, when decisions on savings are made by a woman, the household is twice as likely to save. We also observe that the education level of the migrant is positively correlated with the likelihood of the household to save. And interestingly, we observe that higher information asymmetry between the migrant and other household members, for example, about migrant earnings and remittance decisions, has a negative and significant effect on the likelihood of the household to save. Finally, we also find that households where decisions on savings are made in consultation with other members are more than twice as likely to save as compared to households where decisions are made by a single individual. So taken together, these two final results about consultative processes and information asymmetry make a strong argument about the importance on virtuous financial decisions, such as increased savings, of communication and sharing decision-making responsibilities. And this is an important point as it supports the design of products such as joint accounts that promote communication and joint decision-making. So for the scope of this webinar, I will not go further into the results of the study, but myself and the rest of the team at LEAD would be more than happy to discuss this further with anybody who were interested. If you are, feel free to reach out to us for our social media handles, our website, or directly on Swapcard. Still, I like to use one of our findings from this study as a jumping board for the discussion, especially to introduce our first panelist. In fact, what we observed is that both migrant and household characteristics influence who takes financial decisions in the household and the actual financial behaviors, choices, and preferences of the migrant household itself. And this is an essential finding for both financial institutions as well as governments and NGOs working in the financial inclusion space, as it shows that financial products and interventions need to take into account both of these sets of characteristics in order to be effective. And on this note, I would like to pass the baton to Rupal, who in the next 10 minutes will tell us more about Shams Radi's experience in designing financial services for migrants, especially in light of the COVID-19 pandemic. And thank you. Over to you, Rupa.
Thank you so much, Fabrizio. Really interesting to read some of the insights from your study, and it ties in really well with what I'll be sharing today as well. I hope my screen's visible to everybody. I'll be representing some of the work that we've done in the last 2 years following the COVID-19 pandemic and the lockdown, and specifically talk about how that has really influenced the way we should think about financial services for labor migrants. I'm from Shramsarthi. We are a grassroots financial services institution in the South Rajasthan area of India, and much of the insights that I'll be presenting today is based from this particular region. So we all know that when the 2020 lockdown was announced, we saw those visuals on TV, and we know that migrant families were most affected. We were very curious to understand how did households really manage financially during this time, because cities had come to a complete close. There was no mobility or transportation possible, and migrant families, like we see, earn very little, from 8 to 10,000 rupees per month, with very little savings and a social security net. So we spoke to about 6,600 families in our network. And as you can see on this slide, it basically, on the left, it tells us what percentage of households reported a certain source of cash inflow during the lockdown of 2020, which is from April 2020 to June 2020. So this is data for 3 months. And on the right in the circles, we see what was the cumulative quantum of that particular source for the 3 month period. So we can see that about 75% of the households reported some form of savings at the start of the lockdown, which averaged about 3,000 rupees per household, which also means that 25% of the migrant families did not have any savings whatsoever. And clearly, debt seems to be the primary way in which families seem to have managed during this time, largely from contractors, money lenders, and even goods purchased on credit from local grocery stores. Some of the most vulnerable families that we met had actually sold assets, which formed 15% of the sample that we spoke to. And these are assets such as goats, silver jewelry, in some cases, food grains, and in some really extreme cases, we also see sale of land, etc. So we did a weighted contribution of all of these sources, and we found that on an average, over a 3 month period, families received cash inflows or managed to get cash inflows of about 10,500 rupees through all these various sources, including Narega work and employment. But in the weighted contribution, we see that the government contribution in terms of cash relief and cash transfers was only 10%. So essentially, 90% of the cash inflow during this period was self-generated by migrant households, either by sacrificing assets, working locally, seeking work locally, or even taking up additional debt. When the second wave hit in 2021, we saw that the biggest impact was on savings, because where at the start of the first wave about 75% of the households had savings, by December 2020 only 39% of the households reported any form of savings. And anecdotally, when we spoke to households sometime around April and May, when we were at the peak of the second wave, we realized that almost all savings were eroded. And one of the consequences of this is really that there was a complete collapse of informal systems of emergency financing. So typically households would have some savings through which they would help each other out in case of an emergency. One would borrow from neighbors, friends, relatives. But following the second wave, this was a very clear collapse that we witnessed, where no households had any money to actually lend even informally. And even the relatively better off households that did, we saw that they were really reluctant to part with the little savings that they had, because there was a lot of uncertainty about the future. We spoke to a couple of money lenders as well. Many of the money lenders had also seen an erosion in their capital base. So they were selectively lending out money and even lending it out at really high interest rates. So this was one issue that we identified that we really wanted to work on post-COVID, and I'll talk a little bit about what we did here. But the third big issue that we saw following the second wave was a meteoric rise in indebtedness and really worsening credit scores. And we in our work we often try to distinguish between the intention to pay and the ability to pay. And following the second wave, what we've been witnessing is that a larger number of our loan customers are paying back money, but the quantum of money that they're repaying against their loans is not as much as they should have or as much as they were able to repay pre-pandemic. So clearly, there is a very high intention to pay in that large numbers of people are still paying, but their ability to pay has gone down because they're not able to pay as much. And this is really resulting in worsening credit scores. So I just want to draw your attention to this sample credit score of one of our customers. Now, you can see that they're in the red following the second wave. But if we really look into the details of this particular household, her husband Mohan essentially ran a food cart in Ahmedabad, which was confiscated by the government during the first lockdown. And once they came back locally, they could hardly find any work because these are really shrunk local economies where it's very difficult to find even 5 days of work per month. But at the same time, as a result of the pandemic, they also witnessed three deaths in the last 1.5 years. So they've raked up about 76,000 in institutional debt, about 45,000 through money lenders, and even unpaid bills of about 20,000 rupees. If you look at the pre-pandemic records, they are pristine. But post-pandemic, because they've not been able to recover lost employment or lost livelihoods in urban areas because of loss of mobility and that complete lockdown, we're seeing that their credit scores are rapidly deteriorating and possibly excluding them from the formal financial market. So just to summarize what we're really doing in response to this. So when we spoke about the collapse of emergency financing systems, one of the things we wanted to design was something that would help mimic or replicate that in local economies. So we started a new product, which is essentially a pre-approved emergency financial loan at a zero cost for migrant families. So these are for a certain subset of migrant families who've had excellent records in the past, but we know from our own data that savings has gone down significantly. And so we've pre-approved about 15,000 rupees for a set of migrant households, which would be valid over the next 2 years, where they can redeem this and be assured that they would receive emergency financial assistance within 48 hours at best. And this could be for health emergencies, to pay for food security, for a house that may have been washed away during the monsoons, or even if a migrant had no means to migrate to a longer distance and needed to pay for bus fare or tickets. Um, so the insights here are still new, but we will have more to say on this hopefully in a year or so. The second big piece is, and this is strategically thinking about how financial models should really evolve in response to this change in ability to pay despite high intention to pay. And one of the strategic shifts that we're really making is to say that we need to bring down the cost of capital to the end user. Now, I know a lot of literature says that a lot of rural finance is interest rate agnostic because access matters more than the interest rate itself. But given the new given the new situation today, the environment that we're in, it's becoming very critical to also bring down the cost to borrowers if we want to maintain good credit scores and if we want to ensure that they continue remaining in the formal market. And I think that philanthropy really has a big role to play here, because through philanthropic capital, we can fundamentally reduce the rate in a sustainable manner and provide an ethical alternative to really exploitative debt. And this combined with customized loans, customized installments, financial literacy that focuses on consumer protection and information to action can really go a long way in hopefully normalizing things again for rural migrant households. And lastly, in response to the high level of indebtedness, a new service that we feel is critical is providing customized debt counseling services to not only help them manage high debt, but also prevent additional indebtedness and exclusion from formal markets. So I'll take a pause here, Fabrizio, and then I'm happy to also take questions from the audience later. Thanks so much.
Thank you so much, Rupal. These are fascinating insights and results. So now that we have spent some time talking about the design of financial services of migrants. I think it would be interesting to talk about delivering financial products to the migrants themselves. And I know that we can all spend quite some time to talk about that, but I would like to invite Varun to start this conversation off and talk about what you've learned through the channel network, this very interesting initiative of yours. So Varun, over to you now. Thank you.
Thanks, Fabrizio. Yeah, good morning, everyone. Again, glad to be here. And just quickly, I'm the CEO and founder at Cello Network, which is the implementation arm of India Migration Now. We focus all our work on migration, on mainstreaming migration. And to Cello Network, we are trying to really implement our research and a lot of the findings from the ecosystem. Really the core focus of my work and what we're trying to execute here is how do we deliver services to migrant households, low-income migrant households. That's the fundamental premise for everything I'm going to talk about. So let me just have the slide in at this point in front of us. There we go. It's just loading. Here, thank you. Right. So if that's visible to everyone, let me begin by saying, sort of prefacing this by saying, it's about distributing services to migrants. And part of that is to understand the migration cycle. Part of that is to understand the migration network. And then third part of it is to understand migrant household decision making. So these are the three factors which have influenced the journey that you see in front of you. Now, Rupal spoke, and Shamshaz has done great work on designing products for many years. And so the question for us was looking at the financial services ecosystem and generally, like I said, a broader services ecosystem is that how can we, in a low cost but effective, convenient way, build a delivery system for low income migrant households who are informal, who are multi-locational, and who actually, contrary to many assumptions being made in this ecosystem, are actually still not digital ready. Even if they have a smartphone, from the surveys we have done, from the conversations we've had across India, they're not doing transactions on their smartphones. They're relying on either their networks, offline networks, like friends and families, maybe somebody else has a smartphone, or they're relying on agent networks. What we also see is people don't rely on formal financial institutions like bank branches, there's a reluctance to use that. So all of these sort of fed into this delivery mechanism that we've tried to build called the Cello Network. Cello Network is nothing but a collection of Cello Sathis or agents, last mile agents. And this is where we'll be leveraging the last mile infrastructure in the form of banking corresponding agents, common services centers, and NGOs and other sort of what we call influencers. We're trying to bring them all into the distribution ecosystem through our intervention. And I'll talk specifically later about what we do with these agents, but let me just talk about the journey and sort of some of the design features that we have sort of incorporated. So imagine you have Jitendra. Now, Jitendra is somewhere in Madhya Pradesh where we have operations. And many folks from Madhya Pradesh work in what we call wedding banquet halls in North Delhi. Jitendra has decided that he wants to, go do the season, as marriage season in Delhi. He's got to get there and work and really supplement his income in a big way, his household income in a big way. Now, let's imagine we weren't there, agents weren't there. Then he will be very much dependent on his informal network, which often, for at least half the workers, especially in the seasonal type, are contractors. So he will be really dependent on them to not just provide the job and money, but also ticketing and other fundamental services for him to make the journey there and back, keeping in mind the migration cycle. So this is where what we do is we have a very conveniently placed Cello Sathi, who will probably be a CSC center operator who we have trained, and like I said, I'll talk more about the intervention we do with them, but we've trained and equipped and connected with the local sort of community to further increase the capacity and reach. And one thing they will do is they'll have a ticketing facility either with the IRCTC, which is the Indian Railway Corporation, or with local bus operators. So through this, hopefully Jitendra can get his bus ticket. The other thing that comes up is the issue of documentation. Now, we can talk about financial services, But one of the problems we see, especially once you start going up beyond remittances, which Fabrizio mentioned, how remittances has been formalized quite a bit, and we see that also increasingly in our sample, in our customer base. But once you go beyond remittances, you start getting into more sort of sophisticated financial services like savings and lending. The documentation requirement, the KYC requirements go up and up, and this is where we start seeing strains in the last mile. So one of the things we do, and this is the great joy of working with CSC centers, is that they can, not all, but they can do a lot of help, provide a lot of support to update your Aadhaar and issue PAN cards. This is what they do anyways. And so what we try and do is provide an end-to-end support from KYC readiness to financial services delivery, registration and delivery, and then follow up. So one of the first things a lot of workers like to do is update their Aadhaar. If we introduce the concept of a PAN, many of them know it, many of them don't, and get that process sorted. So let's say he books his ticket, then he gets his Aadhaar and PAN sorted. During COVID times, we realized that another sort of very digital service, which is actually very fundamental for especially workers when they go to urban areas, is get their vaccination sorted. And this is where we have sort of built SOPs with our agents, the same agents, to do vaccine registrations so that they are able to not get their first or second shot. We follow up with them and get that certification. So with Jitendra is by doing this, preparing himself to, not just be working there, but have all the documentation and the prior requirements sorted with the agent network. And also by doing documentation, he's also thinking about his home household he's leaving behind in case he's leaving them behind. So making sure they're able to access services while he's gone. So ensuring their Aadhaar or any other registration is sorted. So all of this through the agent network, all these services are being provided. Finally, from a financial services perspective, you might want to check what we see a lot in our sample is that use these agent points to check their bank balances or withdraw some cash, some liquidity they need. And finally, what we offer, this is where the cross-selling comes into play, is that if they're interested, there's micro insurance with our financial partners available for their health needs. This has been priced and planned in a way that it's suitable for the network of medical providers in the area Jitendra is going in Delhi. So all this sort of compatibility and suitability is built into the services we're offering and the training we're offering our agents. Our agents are a combination of CSE centers, money transfer operators, banking correspondent agents or MTOs, and then what we have influencer agents. This is where our learnings from the network of migrant households really helped. We looked at contractors as potential agents. We have them. We have a lot of last mile organizations who are agents. We have helped convert some NGOs into CSCs and agent points. And the beautiful thing about them is that they provide roaming services. So all these are sort of built in at the source. Great. They're satisfied. Contractor still has a role to play. We're not replacing them. We like to say we work with them. So, for now, the stay and the work is all organized for contractor. He gets there, starts his work in Wazirpur, very close to where I grew up, actually in Wazirpur. And then very conveniently, again, what we've sort of tried to map corridor to corridor, which is from pin code to village corridors, and to build a convenient sort of agent network for migrant workers with a destination they really don't have time. So this is where, to bridge the asymmetries they face at destination, especially Jitendra was first time, there's an agent, this agent very conveniently where they work or stay in Delhi, and his details are shared at source with Jitendra. And this allows them to do the remittance service, which is the most common source of services for these agents. But also, in case they want to sign up for BOCW, any kind of welfare program, that destination-focused lens is also made available through the destination agent. At the same time, in case his wife or his parents or someone want to do claim services, get cash withdrawal, then that agent at source is still there. So this way, we're trying to create this end-to-end corridor-focused service experience. And by doing it, what we're sort of addressing is three things. A, it's the corridor. We're trying to really make sure that the corridor, across the migration cycle, across the corridor, services, endpoints are provided. B, we are trying to give them a large suite of services beyond remittances. And third, C, is that to look beyond complementing services, financial services, right? So you have the welfare piece, which is a common source of funds, as Rupal showcased, but also the documentation support and the healthcare support, which is all contributing to this financial sort of well-being of this household. So this is the model, and this is what we have tried to sort of design as a delivery setup for migrant households. I'll pause there. If there are more questions, I'll be happy to answer. Thank you. Over to you, Fabrizio.
Thank you so much, Varun. Lots to think about and discuss. But I'd like to now move on to Rahul, who will help us tie everything together, sharing some insight from the work that the Coming Foundation India has performed, especially focusing on the household portfolio of migrant households. Rahul, the floor is yours.
Thanks so much, Fabrizio. Let me just share my screen now. I hope this is visible now.
Yeah, thank you so much.
Great. Like Fabrizio introduced, I work with Coming Foundation India and lead the monitoring and evaluation work at the India office here. And today I'm going to talk about, rather present a closer look at the household portfolio of these low-income migrant households, and more talk in detail about the imbalances that it has. And this is based on two of the interventions that we had here, and both of these were in 2020. So the first one is where this was an unconditional cash transfer program that we ran across Bihar and Maharashtra, and under this we provided unconditional cash transfer of about USD $60 to meet the emergency needs of these households for consumption smoothing or restarting their businesses. And it was interesting to know that about 92% of the outreach was amongst the migrant households, and most of these households were living below $4 poverty line. And the intervention was in the active migrant corridor of Navada. That's again a district in Bihar, and in the Vidarbha region of Maharashtra, more precisely Nagpur and Bhandara district. So that was a fast intervention wherein we worked with migrants. The second one is the specific research study that we undertook with these low-income migrant households to understand their household portfolio, social security, and risk mitigation strategies, and specifically tried to assess the impact of COVID-19. And so again, this study was also kind of leveraged the outreach we had with under the unconditional cash transfer program, and was set up in Bihar, Nevada, and it used a mixed method research design. So a lot of the results that I'm going to talk in subsequent sections probably will have a mix of quantitative and qualitative results. So this is a slide I'd probably spend a minute or two, and which will help you gain an understanding of a typical household portfolio of a migrant household. So let's just start from the left-hand side, wherein we are concentrating on the income, and as you'd see, the mean monthly income of these migrant households was about 19,000, and just to make it clear, this is something which was pre-COVID, when before the pandemic struck, and the impact could be, I think Rupal talked about, and also Fabrizio talked about in detail about the impact of COVID on these migrant households, and specifically how their income were reduced. So our study also kind of reaffirmed that, and this mean monthly income was reduced to just INR 11,000. And in a typical migrant household, about 47% of the income, close to half, was contributed by a migrant household. And in these active migrant corridors, most of these migrant workers migrated outside the state. About close to 3/4 of them migrated outside the state, while 1/4 of them migrated within the state. So, and all of these were domestic migrants, and we are practicing. We're working in the private sector or working as some sort of casual labor or working in the farms. So that's about the income aspect to it. Now moving on to the asset part of it, I think there's a lot of studies that already has highlighted the amount of wealth that is locked in terms of the physical assets. Our study again kind of reaffirmed that, wherein we found that a big chunk of the overall portfolio was locked in physical assets, and it could be a land. About half of them owned a land, about owning a house or owning gold. But only a minuscule part of, or rather, very small part of it was the financial assets. And as you could see that only 40% of these households had were saving at a bank account, or were saving at a self-help group was the maximum, wherein no close to three-fourths of them saved at a self-help group. But in terms of financial assets, be it fixed deposit, recurring deposit, or any other financial instrument, there was almost negligible penetration of that. I'm going to talk a bit about this imbalance in my subsequent slide. So moving on to the expenditure part, so the mean monthly expense was close to 4,000, and as you'd see that about close to one fifth of the what they earned were consumed for used for the consumption purposes, and about half of them was spent on food, groceries, and then education, health were the next largest expenditure. Uh, Moving on, just to highlight the impact of COVID here, means when COVID struck, uh, the expense was increased, which was pretty counterintuitive, and also counterintuitive for the people that we were talking to, because they feel that they have cut down on their consumption. But what essentially happened that they had more mouth to feed, more high education and health expenditure, which resulted in increased expenditure, and it was increased up to INR 6,000. So now moving on to the liability part of it. So as you'd see that about one third of the household had a loan, and and these were loans from the formal sources. Only minuscule part of it was from, say, only 9% of these households had a loan with informal sources. But while the once the pandemic struck, this increased massively, and one third of the household reported that they had a loan from the informal sources. And like Rupal was also highlighting it, that a lot of these households were reporting distress selling. So similar was our experience, and one third of the household we found that reported that they had sold something during the pandemic, and although it was mostly the livestock, grains, but and in few cases it was also land or house. So now I'm going to dig deep into the imbalance part of it. So just to understand the reason, I think the one imbalance that was clearly articulated, came out in my earlier slide, was the imbalance between physical and the financial assets. And this is something which is recurring in nature, which and a lot of past studies also kind of highlight it, wherein and this is the Household Finance Committee from the RBI, which reported that about 84% holds 84, an average Indian household holds 84% of the wealth in real estate or other physical goods, and only 5% of they invest in financial assets, which kind of hamper the liquidity very, very much. And similarly, as you would have seen in the earlier slide, that there was a real imbalance for these migrant households also when it comes to how their assets were locked in, be it a physical asset or a financial asset. So, and that hampered the liquidity also. So now the next imbalance that we could really uh, get was the imbalance between the financial awareness and versus the behavior. While interviewing people, we came across that almost 80% of them believe that they need to spend in a social security product, be it insurance, be it a pension scheme. But when it comes to real behavior, there was a wide gap. Only 3% of the households had any insurance scheme, and only 2% had a pension product. And only 20% were planning for the retirement. Rest others were either relying on their son, daughter, or had never given a thought about retirement planning. So therein, the real imbalance lied, wherein people were aware about that they need to do something about it, but when it came into the actual behavior, it never translated into the actual behavior. And the third point, imbalance I'm going to talk about is the imbalance between the financial awareness of migrant and his or her family members. And a significant gap was there in the financial awareness. And this is something we unearthed from the qualitative the study that we had done, which is a family finance mapping, which is more of a gamified participatory research exercise, wherein we tried to, we gave them um, simulated almost a similar experience. How do you spend, let's say, a 4,500, a sum of the amount that they were getting from the unconditional cash transfer, and kind of try to assess what kind of and observe what kind of behaviors, what kind of discussion that they had within the household, and in terms of also knowledge. And the observation was pretty stark in the sense that there's a wide gap between the financial awareness of the migrant and his family members. So next was the imbalance, was the dependence on the formal and informal sources of credit, and this was specifically as an impact of COVID-19. I think Rupal also talked about a lot in terms of how COVID-19 made them switch to rather the lack of formal financial services made them switch to the informal one when the pandemic struck, and in many cases they were not, their friends and relatives were not there to help them out, and in such a scenario means they had to turn to a money lender, loan shark, for running their household. So, like I mentioned, that about a third of the household had a loan in pre-COVID area, which increased to 54%, and the reliance on the informal sources of credit really went up, uh, and, uh, and 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 which was contrary to the reliance on the formal credit, which kind of no dipped from 28% to 21%. So that's the imbalance that was really. Um, and so the last point, the imbalance that I'm going to talk is the gender gap in terms of participation in the financial decision making at the household level. I think Fabrizio also mentioned it in his slides, and about third of the households reported women as a key decision maker, and this was really important because it really translated into the um, high uptake of a likelihood rather of the insurance projects or a pension scheme, and also in terms of the overall household resilience, wherein they were 2.73 times more likely to believe that they could arrange money. So yeah, so these are the five imbalances I thought really stark and important. Yeah, so that's all from me.
Thank you so much, Rahul. Very, very insightful. And we have received some interesting questions. And I am looking forward to the next 15 minutes for the discussion. I would like to kick off the discussion with a simple question for Rupal that I think is going to lead us to a number of interesting questions. That is about something that you mentioned in your presentation around savings. You mentioned that migrants relied on savings the first wave, and we saw an erosion of the same over time. And I'd like to just begin by clarifying, were these primarily in cash?
Yes, these were mostly cash savings. Yeah.
All right, and as a follow-up question, we observed in our own study that while remittances were often sent via formal channels, bank-to-bank transfers, savings, credit in migrant households were still primarily informal. So, for example, cash, right? In the case of savings. So, I would like to hear whether you have any thoughts on maybe why these this formalization of finances has not moved on in the migrant households from remittances to other financial services, and what could be done to change that?
Well, there are several reasons, Fabrizio, why formal services haven't really reached there. I think a lot of it also has to do with the flexibility that services offer to migrants. In our experience, anything that strikes a good balance between flexibility and structure is a great product that works for migrant workers. But if we look at the way savings products are structured, for instance, it's very hard to exit, let's say, an FD or an RD. There are procedures around that. There are barriers to accessing banks, for instance. And like Varun mentioned, very often the distribution network itself is where the pain point lies, because a lot of migrant communities actually come from areas where the physical infrastructure to actually deliver these services is quite limited. And even if they're in urban areas where the infrastructure is good, they may not necessarily have access to it. So we do have a lot to learn from informal services and the way they're delivered, to actually incorporate those design principles into formal finances to make them more accessible to migrants.
Thank you. I don't know if any of the other panelists have anything else to contribute to that. And just in case, Rahul, you mentioned something in your presentation that was that while there was an awareness of the importance of social security products in migrant households, the take-up was limited, which to me is linked to this issue of the savings products and the imbalances that Rupal as well has mentioned. So I don't know if you have any comments on any suggestions or ideas on how to move forward in that regard.
Yeah, so that's no, like I mentioned that the financial awareness about these, the need of these such kind of a product, be it insurance, be it pension, was pretty high. But when it came to the real uptake, it was pretty low. And a lot of it is also due to the fact that there are supply side issues around it. Yeah, we don't have a tailor-made financial product for these migrant households, which kind of cater to their requirements, and at the same time can operate within the complexity these migrant households work. Means just imagine someone living in a Delhi Wazirpur and then needing to access or no, just need to break his FD in an MP far away, far-flung village in an MP. That would be really challenge. So a lot of it has to also be considerate of the scenario in which these households operate, and that includes the whole operating principles around the source corridor as well as the destination corridor. So that's something the design part has to need to take into account.
Thank you, Rahul and Varun. I'll let you comment on the same question. And apart from that, I would also like to point you to the next point. There was a question we received specifically targeted for you. That is, I think that you made a very strong argument about the importance of these of agents targeted at migrants and their households. But we were wondering whether you could comment on the financial viability of these agent networks, since they're not just common service centers and not the traditional agents, but they are almost like field workers. They have to reach out to at least a destination to the migrants themselves and seek them out. So how does, for example, pricing of these services work? But before we go into that, if you have any thoughts to add to the previous question, do feel free to contribute.
Yeah, there's a basic product market gap in the financial sector for migrant households. There's no question. In the pilots we have done, all the financial sector providers we've spoken to, we had a very great partner who was super flexible. You end of the day, I think both Rahul and Rupal mentioned you're competing with the informal informal sort of sources, right? They have their products, they have local knowledge, they have distribution, whether they're contractors, whether they're money lenders, whether they're shopkeepers. Um, these people have nailed that market. We haven't. And I think a part of the job is to learn cues from what's happening there. So, for instance, Rupal mentioned how a lot of the debt is with grammar shops. We've seen that too. I think there's a lot you can learn, just a buy now, pay later model. I think that there's a lot we can sort of explore, for instance, with migrant households there, because their needs, especially when they're trying to migrate. So we are working on a migration startup loan product from a distribution perspective with a financial partner. The idea is that it's very clear the items, just talk to contractors, to spend 2 minutes with the contractor. They tell you exactly what they're financing with the migrant worker. So you can replicate certain elements of that with the like people said, with the flexibility and structure. So sort of this requires a lot of piloting, a lot of testing out, but I think that flexibility, that convenience, both from an access perspective, from sort of really touching the pain points and the needs of migrant households is very important. And I think we don't have to look very far, like I emphasize, just look at how they operate and have operated, because nobody really thought about them. For instance, I'll just conclude by saying, the fundamental assumption in the banking system has been we don't lend to migrants because we don't, because the idea is they need to be static and have a fixed address, then we can track them and so on and so forth. Whereas they are such creator of economic opportunity and need for their households and communities. So why are we ignoring them as potential lending customers? So I think how can we flip that around? Well, look at other people lending to them already informally. So I think that's where this product market gap is a big issue. And I think there's a big need, not from just a distribution perspective, but from a design perspective, where we need to start adopting some of the practices we see informally. And like I said, talk to the intermediaries, talk to migrant workers themselves. They'll tell you everything they need. And of course, it's a question of working with them and testing it. Sort of moving on to the viability question, yeah, that's fundamental to not just the agents, but us as a network. We need to be viable. How do we get there? We have good hypotheses, I like to believe. It's been tested. 50% of agents, look at the work Microsafe has done in India. 50% of banking agents fail. Part of the reason is the way they operate, which is purely about remittances, purely about transaction numbers. There are only so many transactions that are happening in any urban area. Are agents well placed to maximize that? I don't think so. I think half the agents are very poorly placed. When I mean by poorly placed is that they're away from the catchments. A lot of migration at destination is happening in peri-urban areas on the outskirts of the city. You look at the agents there; they're doing pretty well. We've spoken to them. If you're not well placed and you're only doing remittances, and then you're in trouble. Also, exclusive versus non-exclusive agents. That's another issue. There are very few exclusive agents in India. A lot of them are non-exclusive tea shop owners, photocopy, mobile shop owners. Then they do kind of munty on the side. Quality of service goes down. The viability of that piece goes down. They have to rely on other things. The answer to the question is, I would say, twofold for us. One, we got to go beyond, and that goes back to the previous discussion. We need to start looking at other services for this. We need to start building on the remittance experiences of agents with migrant households and start looking at other services which are high ticket. How do we do that? Something that unfortunately agent providers and others are not doing at scale, which is capacity building for agents, training. This has been constant feedback. You look at any report from MSC, anybody, CGAP, that's what they say, right? Train them, provide them better services, give them aspiration beyond just money transfers, right? And that's what we're trying to do. Also, link them to the. They also need to be perceived differently by communities, right? Right now, they're just seen as MTO people. They're seen as these transactional characters in the village with the computer. We need to start changing the perception around them as places where they're reliable banking partners. How do we switch that perception? Part of it is having the right product suite, the curation of it. Part of it is that they need to provide other services, which, like I said, complement the banking services, which is the documentation services. So really tapping into the CSC network the government's built, and they're entrepreneurs. They can work with anyone. They're very open. You give them a machine, they will never say no. So just sort of really tapping the agent network, increasing capacity, offering better services, and at least that's our hypothesis. And the other thing is, like I said, the strategic placing of agents. So this is where the data on migration is a big problematic, especially at the very hyper local level where data makes sense. Anything above that doesn't really help you much after a point. So really positioning them where the catchments of workers are, where they stay, where they come from, That's important because then they're convenient, then they are viable. So I would say these are some of the points we're hitting on the viability quotient. But this journey for us also going forward. I'll report back how that works out.
Looking forward to hear that, Varun, and I think that you're making some very good points. And but we touched something in our discussion that I would like to hear Rupal's thoughts on. That is, migrants, as we know, are obviously, by definition, a mobile population. They're also a not particularly uniform population. We explore dimensions of duration of migration cycles, but there is only just one differentiating factors among many others that divide migrants across different buckets. One thing that I would like to hear your thoughts about is how do we make sure that these migrants are aware and plugged into these networks and the services that you all provide? For example, what is the strategy that Shams Sarati employed in the outreach to migrants that, again, it's not a fixed, it's population, changes over time. Yeah, absolutely. Keen to hear your thoughts on that.
No, thanks for that. That's a great question, Fabrizio. So Shramsarthi is essentially a grassroots institution. So by virtue of that, we are present in communities where the migrants are. And I think given the fact that we're embedded in these communities, we also understand migration cycles. So for specific forms of seasonal migration, we do several campaigns in rural areas through partners and through our parent organizations. We're also present in destination states where these migrants typically go to. So similar campaigns, either very early in the morning or late at night once they're back, or sometimes even at work sites and so on, or Narega sites. Really trying to figure out which is the best time to find a certain type of migrant during the year and as well as during the day to do intensive outreach in these communities. The other big piece that we rely on is really community volunteers. A lot of these volunteers are migrants themselves who've undergone certain experiences in the past and who've worked with us very closely in the past and understand us well. And so they just really want to pay it forward within their own communities. So a lot of them also assist significantly in outreach. But a big differentiator also is that with Shramsarthi, at least, nearly 80% of our team is from the local community. So they're all young boys and girls who've had migration experiences themselves in the past. So there's a high degree of empathy, and that also aids us a lot in both product design and outreach. Yeah, I hope that answers your question.
Yes, it does, Rupal. And just, wrapping up, Rahul, I have the last question just for you. If you could answer it as quickly as possible, it would be great. When we look at the income and expenses number, there is a large amount that goes into savings from these migrant households. Yet, we said maybe informal savings, but that doesn't really matter. But we see that often there is a struggling with meeting financial needs. What's going wrong there? What's happened? What can organizations like Grameen Foundation and others do to change that?
Yeah, that's a pretty valid point. You should see that there is in a pre-COVID era, there is a wide gap of about 15,000 rupees, but we'll also need to understand how the savings as well as first categorize that, and also try to understand how these needs of these households are. For example, a migrant household has some immediate needs, and they would save for that. Let's say, a migrant worker from Bihar would go back to Bihar during Chhat, or say, or sowing time. So that's an immediate need they have, and they save for that, and probably won't like to invest any. But there are few needs which are long term, and probably they can have better financial instruments that they can use for savings. And therein, I think the imbalance that I talked about, that a lot of imbalance in terms of the amount of wealth that is locked in terms physical assets versus the financial assets, that is really one aspect of it. That is some, and that is also to the point that many of Varun and Rupert made earlier, that there's a lack or rather dearth of good financial products or tailor-made financial products for these households. So therein means an offering which kind of really engages and kind of attains to their need, and two, means the adoption or uptake of the risk mitigation products, social security products, be it insurance, pension, things such as those.
Right.
I think then that would be really helpful with these households.
Right. Thank you so much, Rahul. That was very insightful. And with this, I'd like to wrap up the session. Lots of very interesting insights, and I would like to take this opportunity to thank the speakers, of course, for taking the time to participate in the session and share these very interesting insights and results. I would also like to thank everybody else from the lead team that has provided time and support to make this happen, and of course, CFI for organizing Financial Inclusion Week. And then finally, I would like to thank all the participants to these sessions that have taken the time to listen to the discussion. I hope you found it interesting, and you're taking home some good insights. And we'd be happy to continue the conversation on swap cards, on social media, and feel free to reach out to myself or any other speakers for any further insights. And so we look forward to the next sessions, and thank you all again.
Thank you.
Thank you, everyone. Thanks.
Thanks so much. Thanks, everyone.